On Sunday, Japan's government announced $6 billion in new spending. By Monday, Japan's 30-year government bond hit an all-time record high.
The bond market noticed Sanae Takaichi built her political career on a specific promise Japan would finally get its fiscal house in order. She was the rare Japanese politician who said the quiet part loud. Decades of unlimited spending, of printing money to hold yields down, of pretending that debt doesn't matter because it's denominated in your own currency, had to end. Fiscal discipline was her brand.
She won the election in October. NCNCFRU on that platform. Then, in January, NCNCFRU she launched a NCEDN trillion stimulus package, roughly back Sansi $1 billion. Before a snap election, markets flinched. The 40-year government bond yield hit C% for the first time since that security was issued in UEA. NCNCETA analysts compared it to the UEA Kaliz Trust mini-budget disaster.
Takaichi's team called it Sanaeconomics, her name, plus economics. Markets called it something less flattering. Then, on May Arsavul, Arsindra Ilteri Uriuj reported what markets had been dreading. Takaichi had announced another supplementary budget of approximately yen trillion, $6 billion, to subsidize household energy and utility bills. This, according to Reuters, was a reversal from Takaichi's previous remarks ruling out the need for extra spending.
The bond market responded immediately. Japan's 30-year government bond yield reached its highest level ever recorded, surpassing even the May fiscal record. The 10-year bond hit 9.5% in mid-May, the highest since May Chubak Q17. These are not abstract numbers, they represent a direct cost to a government that owes more than 50% of GDP, the highest debt ratio in the developed world.
To understand why a Japanese government bond yield matters to you, even if you've never owned one, you need to understand what Japan represents in global finance.
Japan is the world's largest net creditor nation. Japanese institutions hold approximately $8 trillion in U.S. Treasury bonds. Japanese insurers and pension funds own hundreds of billions in European debt, Australian bonds, and emerging market assets. They bought these foreign assets because Japanese yields offered almost nothing for 3 decades. The Bank of Japan capped rates through a policy called yield curve control. When yields tried to rise, the BOJ bought bonds until they stopped.
That era is over. The BOJ began raising rates in Nisen Nifersen for the first time in 10 years. By December Nisen Nifer it had abandoned yield curve control entirely. Now, Governor Kazuo Ueda has called the rise in GB yields rapid and says the BOJ stands ready to conduct bond operations flexibly. Central bank language for we're watching but we're not rescuing.
The BOJ's actual position was spelled out bluntly by Reuters in February. The central bank won't come to the rescue of a Takaichi-driven bond rout. Any attempt to cap long-term rates would contradict the BOJ's gradual rate hike path and risk reigniting yen weakness. The BOJ's deputy governor Masato Himino confirmed this framing as recently as May 96, saying appropriate policy, meaning rate hikes, is the key tool for bond yields, not direct suppression.
So we have a situation where the government is spending more than it said it would. The central bank is raising rates rather than buying bonds to limit the damage, and bond vigilantes, the investors who sell bonds to punish governments for fiscal irresponsibility, are doing exactly that.
The last time markets successfully disciplined a major government this way was the UK in September when Liz Truss's unfunded tax cuts triggered a gilts crisis that ended her premiership in shorter show days. Japan's situation is structurally different. The debt is overwhelmingly held domestically, and Japanese households and institutions are stickier holders than international speculators. But structurally different is not the same as immune.
With bond market pricing now reflecting an approximately 20% probability of another BOJ rate hike at the June fiscal policy meeting, the cost of Takaichi's spending reversal is about to get more expensive. When the BOJ raises rates, it raises the cost of the government's own borrowing. A debt load of 3% of GDP becomes materially more burdensome when yields move from near zero to 3% and potentially higher.
Here is the thing about Takaichi's reversal that gets lost in the bond yield headlines. Her justification was technically defensible. The supplementary budget, her team explained, was offset by stronger than expected tax revenues and projected underspending elsewhere in the budget. Total bond issuance for FY2 would remain unchanged from the original plan. No net new borrowing. This is not a complete fiction. The government has in fact been reducing its deficit-financed spending as a share of the budget. New bond issuance in FY2 is on track to fall below 30 trillion for the second straight year, reducing the debt-financed portion to a nearly 3-decade low.
This is the Japan factor in action. Japan's political system has a remarkable capacity to justify contradictions through technical framing. The spending is stimulus but also not stimulus. The reversal is a reversal but also fiscally neutral. The Prime Minister abandoned her previous statements but only because of external shocks, oil prices, the weak yen, the aftermath of Middle East conflict, that she could not have predicted.
Every single one of these things is partially true. The problem is that bond markets don't grade on a curve. Investors watching Japan in Nushen have already seen one major fiscal surprise in January, and now a second in May. The technical arguments about revenue offsets are real, but they require trusting that the government will not find another reason for another reversal in August or October, or in response to whatever the next external shock turns out to be.
Takaichi herself tried to address this directly, stating, "In guiding economic policy, we are mindful of the importance of fiscal sustainability and will remain so." It is the kind of sentence that sounds reassuring until you remember that she said something similar before January's stimulus package and again before May's supplementary budget.
This is not a Japan-specific problem. Every developed country government faces the same tension: the short-term political incentive to spend during a crisis, and the long-term market discipline that punishes credibility violations. What makes Japan different is the scale. When you carry 6% debt to GDP and your central bank is no longer your backstop buyer, every credibility test is higher stakes.
The United States has been having a version of the same conversation. The UK had it acutely in Nate. Germany has been having a slower version for years, but none of those countries owes as much, relative to their economy, as Japan.
Japan's bond vigilantes are not a hypothetical. They are here, they are active, and the 30-year yield at an all-time record is their answer to the question of whether Takaichi's spending reversal was fiscally credible.
The BOJ's June meeting is the next major data point. If they hike rates again and the market assigns it an 8% probability, Japan's government will be paying more to borrow on a debt load that is already the largest in the developed world. That math becomes increasingly interesting at 9%, at 3%, at 4%.
The question is not whether Japan's fiscal situation is sustainable today. It probably is. Japanese households hold enormous savings, domestic institutions are loyal holders, and the no net new borrowing argument has real merit.
The question is whether it remains sustainable through the next reversal, and the one after that. Takaichi promised fiscal discipline. Then she announced 3 billion in new spending. Then bond yields hit an all-time record. The market is not calling Japan insolvent. It is calling Japan's government's word into question.
In bond markets, that is an important distinction, but it is not a comforting one. Word count, Sanaeconomics words, estimated duration, 8 yen war minutes at, Packles is WPM format news flash.